Hello, friends. James Stevenson here. This is it. This is part 4 of 4 on my detailed forecast review. If you haven't seen the first 3, go ahead and take a look at those first. I will leave a link in the description to those. And if you haven't had a meal recently, maybe pop a bag of popcorn, grab a beverage, settle in for a while. This is going to be an in-depth dive into tweets 18 through 69 of my most recently tweeted forecast, which I have pulled up here on Twitter. So the link is also in the video description for you, so you don't have to hunt it down. Let's jump right into it. So tweet number 18, 19, 20, and 21. These are showing 4 of the charts that have been with me the longest. I've been using this format since 2018, I think, to forecast these years, and they're all actuals now. So after these, we'll get into my actual detailed forecast for future time periods. But first, let's take a look at how the actuals finished up. You know, when I first started forecasting these fiscal years, I had the direction right and I had the story right. I didn't have the magnitude right, but you know what? The timing is harder the farther out you try to forecast. And we didn't know things like COVID were going to happen ahead of time, right? So I feel like I did better than those who got it directionally wrong. But the story here is the same story that I thought it would be when I started forecasting this a while back. You can search Twitter for my older versions of this forecast. But the gray highlighted row on here, come here, Loki. Loki wanted to make an appearance in the detailed forecast video. So say hi to the camera, Loki. Say hi to the folks at home. Loki's my chihuahua, and he wanted to be a star today. So let me put him back up. Ooh, he's tangled in my earbuds. Why do I even have these earbuds on? I'm not listening to anybody right now. I'm doing all the talking. All right. Yeah, I was going to say the adjusted EBITDA line is highlighted in the middle of the page because I think this is what's most important to take away from the page, the story in the growth of adjusted EBITDA over time. It was never over $2 billion until Q2 of 2021, and then it was 3, and then it was 4. Do you get it? This here is the story that I was, you know, forecasting the whole time, up and to the right growth for the blue, which is vehicles sold. This is deliveries. So the blue line here is on the right y-axis. Everything else is dollars. So these are units sold, the blue line, but the green line is revenue dollars. The dark gray area is the fixed costs, and the light gray area are the variable costs. Now I have to overgeneralize here. If you want to get an entire P&L, a profit and loss statement, to fit on only 4 rows, you have to compress a lot of stuff into operating expenses and into cost of sales. So, but the important thing is this area between the green line, the revenue line, and this lighter gray, so this really light blue area here is the adjusted EBITDA. And you can see the steeper the revenue grows, if the total costs are not increasing by as much, you're going to keep getting more and more adjusted EBITDA, more and more profit. So that's what happened. The deliveries grew. the revenue grew with it, even though the revenue per delivery decreased as the mix shifted away from Model S and X back here and into Model 3 and Y over here. And then, these more fixed costs do continue increasing slightly over time, but not by nearly as much as the revenue does. So this is the operating leverage that drives profit growth. And you can see that story being told on the auto gross margin, excluding regulatory credits line down here. In one of the previous videos, we had a chart showing this metric, but you can see it really getting to a good place by the end of 2021 at almost 30%. And then the earnings per share came with it from negative numbers at the beginning of 2018, and then again in Q1 of 2019 and Q2. But a tremendous amount of growth in earnings since, and you can expect that story to continue into the future. All right, I promise that I will not spend 5 minutes on each of the remaining tweets because we have a lot of them to get through. But let's go to tweet number 19. This is showing us the number of vehicles sold. Again, I've been using this template for a long time. I forgot to mention in the previous videos, Model S and X were refreshed in 2021, which is why these numbers are down so much from where they were in prior years. So hopefully we'll see a lot more Model S and X deliveries this year and in the future. Then I've got the automotive revenue per delivery here. So you can see that in total. And what I believe the spread is by model. And you're going to hear a lot of that because going through our detailed forecast soon, I have to make reasonable inferences about what the breakdown is by model because Tesla does not provide a detailed breakdown of Model 3 versus Y, Model S versus X, or by site. And then, yeah, the number of vehicles sold times the revenue per vehicle gives you the revenue by model. So you can see where the automotive sales revenue comes from by model in this table. All right, let's keep moving to slide 20, tweet 20 out of the 69 tweet thread. This is the income statement. So you've got the revenues at the top of the page, standard P&L format, right? This is the same format in which Tesla reports the earnings in the quarterly 10Q and the annual 10K. And you've got the costs underneath that. So these are the direct costs or the costs of sales or costs of goods sold. These are just the costs related to what people bought when they spent this revenue up here. So if you buy a car, the cost of making that car, etc. So that gets you to the gross margin line, and you can see how the total gross margin is doing here. We'll have more detail to look at on future charts for these. And then below the gross margin line, we have research and development, selling, general administrative costs, and sometimes there's a restructuring and other that comes through and hits, not always, which gives you your operating profit, income or loss from operations here. Then we've got like interest income, interest expense, taxes, and then some adjustments down here for non-controlling interests, which gets you to the GAAP profit line, which has been growing a lot from where it used to be years ago. All right, what does slide 21 tell us? So you got a share count here. So earnings per share are here. These are GAAP earnings per, GAAP earnings per share here. You'll see non-GAAP later on in the forecast model. These are really more summary pages than a detailed breakdown. And then you got the share counts are here. The automotive gross margin is here. This is including regulatory credits, this one. Then I'm showing a breakdown of the automotive cost of sales percentages. So how much do each of these types of products cost as a percentage of the revenue driven by those divisions? So you can see energy generation and storage is not the most profitable division of Tesla's business, which explains why they haven't been getting priority on cell supply. If if automotive needs cells, they get them first because automotive has lower cost of sales percentages. It's more profitable to sell someone a car with a battery pack than it is to sell a mega pack or a power pack or a power wall. All right. And then there's a breakdown here by site and by model where I lean heavily on Troy Teslike for the actual time periods to understand how the deliveries broke down by site and by model. He does a great job, and anyone interested in Tesla deliveries and production ought to be following Troy on Twitter. All right, let's move on to slide 22. So this is the beginning of my detailed Excel model where I go through in very rigorous detail to build up my forecast. And I'm not going to talk about each one of the slides in this area because that would take a long time, but I do want to give you an idea for what's going on in each section where something new and different is happening. So I'll try and do that as we go through. I did leave a note in here. If you're in a hurry to see the income statement and like just tell me what the earnings are, then skip on down to tweets 58 through 60 where that information is. But the approach that I wanted to take with these, here you can see we're only looking at 2020 through 2023 in this look. So the first 8 columns here are actuals and the last 8 columns are the forecast, what I'm expecting to have happen. And I'll just walk you down an example. So for Q1 of 2022, how many Model S deliveries do we think there will be? And Model S is only made in Fremont. So there's a production capacity of 1,000 Model S's per week. They can make about 50,000 Model S's per year, and they can make about 50,000 Model X's per year. So you see Model X is next on my list. So that's your first assumption. Hey, what's the design capacity of the line or lines that make this model at this site? Then how many weeks of production do we think there are or were or will be? And what do we think the production efficiency will be for this model in this location? And we know Tesla is pretty demand constrained or pretty, sorry, that's going to get clipped by somebody. Tesla's supply constrained. There's more demand than Tesla has the ability to meet. Somebody's going to say that was a Freudian slip, but it was just me misspeaking. And if you want proof for that, hey, if you, maybe you don't believe James on this one, go try to buy one on Tesla's website and tell me how long the wait is that they quote you to get a Model X. I think people are getting quoted next year for delivery on Model X. Tesla is trying to make them as fast as they can, but there is a long backlog of orders to be filled. All right, I think I have recovered from my flub sufficiently to keep walking down the page. So what does this give you? A times B times C equals vehicles produced. If you know what the capacity is per week, and then you know how many weeks of production there will be, and you know what percentage of design capacity will be achieved during that time period, then you've got a production forecast. Okay, so the next thing you need to know is how many of these vehicles were there at the beginning of this period. So that's my beginning finished goods inventory count here. So how many Model S's could possibly be sold in Q1 of 2022? Well, they're limited to only the ones they had in inventory to begin with, plus the ones they made during the quarter. You cannot deliver more than that. So your next question is, well, how many do we think will still be in inventory at the end of the quarter? That's what this ending finished goods inventory forecast is about. And this is about guessing at how many days of ending inventory they're going to have on hand. So it's just math to get from here to here. If you've got this much available to be sold and that's your ending inventory, then you must have sold this many. That's your deliveries count. And we also need to forecast of these total deliveries, how many of those, this is a memo item, not additional deliveries, how many of the 12,124 are going to be leased? And I'm forecasting just shy of 1,700. Okay, so that's how this works. You do that forward for future time periods. I'm not forecasting crazy growth for Model S. Tesla believes they're going to sell about 100,000 per year of Model S and Model X combined. And that is about what I'm forecasting as soon as Model X gets up to speed. I have them ramping up steadily, but maybe not very quickly across the year to try to be conservative. For every assumption I make in my forecast model, I try to I try to use an assumption that that best represents the midpoint of a likely range of possible outcomes. What am I trying to say with that? I'm trying to say a lot of different stuff could happen. I could be wrong low or high on any of these assumptions. And I would like for there to be a 50-50 chance on every assumption I make that it's low or high. That's what I'm aiming for. I would love to get all of them very close, but that's not going to happen. If you've made very many forecasts, you know that they're all going to be wrong. Whatever you forecast, it will be wrong. This is a law of forecasting, but you want to be less wrong over time by learning about the reasons why your previous forecasts were not right, and apply those learnings to your future forecasts. All right, so after Model S and Model X, we've got Model 3 here. The capacity is a lot higher on these, but I show lower production efficiency percentages here because Fremont uses some of this capacity to make Model Y now. So I'm going to go to the next slide. So let's go to slide 23. I did make a similar statement here. I find it helpful to revisit each granular forecast assumption twice per quarter minimum, and I do that. I mean, I update this forecast a lot more often than twice per quarter. I only tweet it out publicly twice per quarter. So, but I do go all the way down the whole page and look at all the assumptions twice per quarter to see if I want to change anything based on new information that's always coming out. If you follow enough of the right Twitter accounts, you know there's a steady stream of gossip and information that needs to be weighed up for reasonableness and included where it makes sense to. So yeah, I include weeks of production, price changes, and sales mix. And this is not the easiest way to forecast, is what I'm trying to say here. There are easier ways to forecast an earnings number, like some of them are very quick. But if you use one of those extremely fast methods to forecast, you might inadvertently forget about something that you would not have forgotten if you had forced yourself to think about every detailed assumption for each site, for each model, for each dynamic that impacts what the financial outcome could be. All right. So this slide 23 is showing us the detail on the assumptions for Model Y and its capacity continuing to ramp up is my expectation. Um, Tesla has told us that they can still get more production out of Fremont. So Model Y must be part of that equation. And I expect them to do a good job utilizing that capacity as it comes online, producing more vehicles than they have in the past, and delivering more vehicles as they keep their days of ending inventory roughly in line with where they've been previously. All right, so that's the Fremont production and deliveries detail forecast section. After that comes Shanghai. So Model 3 was the first vehicle they made, so it comes first on my list. We've got them producing more than they ever have before. I mean, look at this growth, 87,360 worth of production of Model 3 in Q4 versus where they started the year, 62,000. Now, I know these are estimates that are not official from Tesla, but if you add them up, if you look at the totals, you'll see the same the same story is in there. So it's only a question of where you think that story is happening. It makes more sense to me to believe that more of the growth is coming from China than to believe that it's coming from Fremont, right? As that facility scales up and does more over time. Let's look at the next tweet to see the production and deliveries forecast for Model Y, a more relatively new addition to what they're producing from that factory. And it has scaled up in a major way and should continue to grow this year and into next year. I mean, these are going to be big year-over-year beats on production and deliveries out of China, seeing how low these numbers were this year, meaning 2021. So 2022 ought to show a lot of year-over-year growth, big percentage growth. All right, after Shanghai comes Berlin. They're not going to start with Model 3. They're going to start with Model Y. So you can see the first part of that here. Let's look at a better view of this one. So I noted here, I have the Model Y production ramps beginning from Berlin and Austin in Q1 2022, but at low counts. I probably won't miss Q1 by very much with amounts this low. Let's take a look at what I mean here. So for Berlin, Model Y, I'm only expecting 3,200 to be produced in Q1, so by the end of March, and only delivering 2,880. Now we'll see, even if they deliver 0, I'm not missing by more than 3,000 on this deliveries estimate, but we'll see how I do. Then there is no European model announced at this time, but there was a Berlin design studio spoken about a few years ago, which is why I have a placeholder in here for it. Then we get to Giga Austin, the Texas Gigafactory. It's also now producing Model Y vehicles. So we don't know of any deliveries for those Model Ys yet. Maybe they're still all for line validation testing and just as company internal use cars, but we'll see. The next vehicle that is on the list is Cybertruck. So let's take a look at it here. So I've got Cybertruck starting slow a year from now, so Q1 of 2023, just a few, then ramping up from there to, you know, maybe as much as 50,000 production run rate by the end of 2023. That doesn't seem very aggressive to me, but it's always difficult to pick the beginning of an S curve correctly this far in advance. So we'll see what happens. Then we have the Semi Now, some semis are already out there, and I've got zeros here because I don't think Tesla has reported any of those semi production and deliveries yet. But I've got, you know, 10, 20, 30, 40, maybe we make 100 semis over the course of this year, 2022, and then it'll ramp up from there. That's what I have in here, more like placeholders than anything else. Tesla needs to move the semi production validation line setup from Nevada near Gigafactory 1 to Austin and then start it back up again. So we don't know what the production and deliveries will look like, but my expectation is that we're not going to see lots and lots of semis being delivered even by the end of next year, because they just need so many 4680 cells. And it's unclear that Tesla is going to be at high volume production of 4680 cells very soon. So I hope to be wrong about that and have them hit that out of the park, but we'll see how it goes. Then at the bottom, for all sites and models, this is just me totaling up everything you've seen previously. So total production was 305,840 in Q4 of 2021, and 308,650 was the final number reported in the 10Q or the 10K for 2021 full year. So I'm not expecting huge growth from that in Q1. Q1 historically is a seasonally weak quarter. Most of this growth is going to come from China because they ended the year so strongly. I didn't feel like tapering down their growth rate. It didn't seem reasonable to, but then after that, we should see some pretty strong growth Q2, Q3, Q4. And I've got calculations here for how you have to do days sales of ending inventory. You use a 75-day assumption. I don't know whose idea it was to say that a quarter has 75 days in it. Maybe somebody wanted to throw out weekend days. I don't know. Let's go to the next one. So I also have totals by site. So if you were ever interested in what Fremont production deliveries are, I mean, Troy Teslike is a great follow for this, but I have a different way of presenting the information here if you'd like to see what I'm expecting for the total site for each site. So that takes you to the end of the first section of my detailed forecast model. That's the production and deliveries part. It's just figuring out how many units of vehicles are being produced and delivered and the associated metrics with those. Next, you have the question of, all right, how much money are we going to collect from selling all those units? So the approach that I'm taking is to go through the order page for each model and look at all of the options that they give you that you could select to go with your purchase of that model, right? So that's what you see here. You've got a base configuration. This is the minimum that you could pay and get that vehicle. As you can see from Model S, that number used to be a lot lower. They're charging a lot more now for Model S than they were this time last year. And after that, it's multiplying the price of each option by a take rate that I'm assuming is going with those orders. So for paint, this 1,600 represents an average of $1,600 paid for the not free color paint options for Model S vehicles from Fremont. That's what this is giving you. Then for performance package, you know, those were very, very strong sellers in 2021. I would expect that to come down in 2022 as a lot of those orders were prioritized and filled in 21. Let's see. Wheels, interior, full self-driving. So this is one of the key assumptions in my forecast model, is that we have seen the full self-driving revenue per vehicle rise over time. And, you know, from 3,000 to 5,000 to 8,000, 10,000, 12,000. it seems likely, and we've heard from Elon, that the price of full self-driving will continue to rise as the features of that software improve. The better that level 2 autonomous driver assistance feature gets, the more Tesla will be able to charge for it, because people will uh, find it to be more valuable, right? The less you have to intervene, the more impressive the feature is, the more useful it is, and the more Tesla can charge for it. And the more people will buy it. So you've got a take rate increase to go with a price increase, is what I'm assuming will happen over the next couple of years for not just this model, but for all the models. And so that gets you to the cash buyer ASP. Okay, when I placed my order for my model, how much did I say I wanted to option it up for? Then between there and the revenue per delivery number, which is down here, you've got a bunch of adjustments that you need to make. What are those? Well, one of those is for leased vehicles. You're not getting that whole amount because the person leasing it from you isn't going to pay you that whole amount. They're going to make payments for 3 years and then give you the car back. So on average, that's a contra revenue, a credit against revenue of, about $10,000 on a Model S. Then every vehicle gets charged a destination and delivery fee. You don't see that when you place your order, but they all pay it. Then Tesla makes revenue per vehicle when they sell regulatory credits. So those go here, zero emission vehicle credits in various jurisdictions around the world are worth something. And Tesla can sell those to competing automakers who did not produce enough zero emission vehicles to comply with laws requiring them to. Then you've got other. So this is where I'm throwing the FSD deferral revenue. So up here, I've got how much people are paying for FSD. But down here, you see these negative numbers over here. I'm offsetting that revenue because some of it has been deferred, meaning that Tesla could not take it as revenue on their income statement on an accrual basis because they had not performed the delivery of all the features that were bought. They've only delivered fractionally on the features that were promised to go with full self-driving. So until all the features are rolled out to that buyer, some of the revenue or some of the price they paid at delivery is deferred until such time as Tesla makes good on performance of all those features to that buyer. So OT upgrades go in here, acceleration boost, that sort of thing. Data plans, whatever else Tesla would count as automotive revenue per delivery. So that's how that section works. Then I've got a calculation here that shows how much revenue was driven by this model. So in Q4 of 2021, I'm guessing about 1 billion of the revenue that Tesla declared in Q4 was from sales of Model S vehicles. Let's keep moving. You've got the idea on that one. So I made a note here. It does take me a long time to tweet out a 69 tweet forecast thread. Fremont Model X is next. You see similar logic here. Those were cheaper a year ago. Now they've been refreshed. It's cooler now than it used to be. So they are able to charge more for them at the base configuration level. Now, early in the ramp, they also cost more to make because you can't make them as efficiently at low volume. So we'll see that later. But similar idea here. So you've got the revenue by option type, and then you've got the adjustments to get to total automotive revenue per delivery. So Tesla did not make a lot of revenue off Model X last year, but hopefully this year that will change and into the future. All right, so we got Fremont Model 3 here, much lower base configuration starting price on that vehicle from Fremont, but that's been rising. I mean, a year ago this time, a Model 3 started at 36,990, so 37,000. It's at 42,000 or 43,000 now. And as these price increases go into effect, you may say, hey, James, it's already 43,990 or 42,990, whatever it is today. Well, yeah, but there was a backlog already, and the people who placed those orders placed them when the starting price was lower, mostly. So anytime a price change is announced, I have to feather that price increase in to the base configuration to faithfully represent that the people who are already in the backlog have to have their order price honored by Tesla at whatever they agreed to pay for their vehicle. So I'm expecting this is going to peak toward the end of 2022 and then come back down again. Who knows? That's just my forecast expectation on that. And then here we see again that full self-driving expectation that it's going to increase over time in general. Let's close out of this and go down to the next one. This is Fremont Model 3. You see a similar story here, except for the base configuration price. This has gone up a lot. Model Ys are not cheap. So the standard range used to be the base model, as Loki makes a racket in the background chewing on his toys. Oh, I feel like Ryan McCaffrey right now talking about my dog making noise. That I can never hear the noise that Ryan's dog is making in the background when I listen to his weekly Tesla podcast, but he's always careful to note that. If you don't listen to the Ride the Lightning podcast, I don't know if you're really a Tesla fan. You got to listen to that podcast. It's great. All right. Shout out to Ryan McCaffrey at DMC_Ryan. Okay, so let's go to Shanghai Model 3. So this one has a lower base price. They do offer a standard range. Well, it's the same price as it is at Fremont for a standard range Model 3. And what you'll notice, a big difference here is the regulatory credits amount has gone up. So in China, you know what the regulatory credit value is over time because they get set at auction a long time in advance. So that's graduate level Tesla forecasting right there. Then for the full self-driving line, you'll notice that I had to take this down a lot when it was revealed that the Chinese consumers are not purchasing FSD at nearly the rate that others are in general and so far. So I think they're maybe taking a more wait and see cautious approach to, hey, is this really going to work? I don't want to overpay in advance for features that might not work where I drive my car. And then we'll see that revenue growth as more features get rolled out in China for full self-driving is my expectation, but that'll be slow growth and from a low base. So that's how I build up to the revenue per delivery for vehicles made in Shanghai. Let me move down to tweet 32. I'm losing my place. There's not a lot of information on this slide. Let's go to slide 33. Okay, here we have Berlin Model Y. So I already had information in here for Q4 of 2021, and I just left it there. I think the revenue for this model is going to build pretty quickly once they're up and running. Knock on wood. So hopefully they start up real soon, and we start using the Berlin Gigafactory to satisfy the European demand for Model Y, which is strong and has been fulfilled lately out of China. Then I have this placeholder here for the Berlin European model. I mentioned that earlier. So I'll keep going to slide 34, where we talk about Texas. Let's hop a plane to Austin and check out the solar roof on the Tesla Gigafactory. It does look like maybe they're going to be spelling out TESLA on the roof of the Giga Austin factory. That would be pretty cool if that happens. That's reckless speculation on my part, though. I don't know that that's going to happen. All right. So what do we think the Texas Model Y is going to do? Probably very similarly to what the Fremont Model Y is going to do. I don't think there's going to be a big difference in the spending choices between East Coast and West Coast of the US, which I think is the differentiator on the Texas Model Y versus the Fremont Model Y. Then for Cybertruck, I'm still holding $49,990 here as the starting price in case Tesla honors those who booked reservations for it at this price. It's also possible that they will need to raise this price for Cybertruck, but we'll see how that goes. That'll be 2023. We got some time to speculate and gossip about that one. Let me scroll down to slide 35 out of 69. So we are now more than halfway through this thread, if you can believe it. So we have Semi here, starting at a $150,000 base price with a $20,000 performance package option on that. I think this is going to be a mix of 180 and 150, with 2/3 of it going for the $180,000 model is all that means. There are not other options on Semi. I think if you want it painted, you have to paint it yourself, or maybe they're free no matter which color you get. I don't know. We haven't seen an order page for Semi, right? But you will have full self-driving on there, and I think people are going to want to test that when they get their Tesla Semi. So it should be a pretty solid take rate on full self-driving with the Semi. But again, these volumes are going to be very low for a while. Maybe not anything much to talk about until late 2023 for Semi, just because of the cell constraint problem. All right, so that adds up to totals for all sites and models here. Just adding up those average sale prices. Then I've got totals for Fremont, for Shanghai, for Berlin, for Texas, and then below that, we get to something interesting, which is the total revenue dollars first, excluding leasing, then the revenue just for leasing, and the total revenue including leasing. What happens next? So a $15 billion number is what got reported for total automotive revenue in Q4. And it takes me a while to tie out this model at the end of every quarter to what actually gets reported by going back up and adjusting enough variable assumptions to get the right numbers to kick out at the bottom line for these totals. But that is how I do it, because I want to do it the right way, and I want to learn from the adjustments that I'm making and apply them to future quarters so that I don't get the same problem happening again in the future, to the extent that I can help it. Now, this stuff changes over time too, so it's a bit like the mallet game, if you've ever played that in the arcade with the prairie dogs or whatever aliens. Every time you hit one, another one pops up. So after we total up the automotive revenues, below that section, I've got some other metrics here. So I've got a revenue check figure. So every good Excel spreadsheet modeler knows how to put in check figures where it's possible to do the math two different ways. You go ahead and do it the other way, and then subtract the number that you got doing it the first way to see if both methods get you to the same answer. That's what check figure rows are about. Then for solar megawatts deployed, this is how much energy production uh, volume was sold in each quarter. This number gets reported and I include it. Not expecting a lot of growth right away, but I am expecting growth over time in this metric. Then for storage deployed, this number was down some in Q4 from where it had been in Q2 and Q3. So I'm expecting growth, but not right away. Then we've got the metrics on revenue per watt and revenue per watt hour here, just to make sure those are seeming reasonable. It seems like at higher volumes, these ought to get a little more efficient over time. We'll see how that theory plays out. It seems like that's what's been happening over the past, is that these dollar amounts per watt and per watt hour have been coming down. So I'm trending forward that. Then we've got non-automotive revenue dollars here. So these are the Tesla energy products. Solar panels and solar roof are production. The rest of these are storage. And then there's an other line here, which includes energy as a service revenue, which could grow a lot over time. And we don't get this breakdown, so it's a guessing game to figure out how much each of these products has gone up or down over time. Then there's a line here for services and other revenue. So this is parts and labor, parts and service at the service centers, plus Tesla merchandise sold on the website, and used car resale, that sort of thing. That's it for the revenue section. So I've got a total revenue line here that adds all of those different types of revenue from the different divisions up. Then I've got a line here that shows just the regulatory credit revenue and the growth rate in that regulatory credit revenue year over year. So how much is that moving up or down on and then I've got this old row here from the Fiat Chrysler Automotive regulatory credit sales deal. So they had a pro rata commitment to purchase regulatory credits, and I was keeping track of that here. Sometimes I confuse myself with my own spreadsheet. All right, we're on to slide 40. So this is the section that begins cost of sales. So this is the same idea as the revenue per vehicle section. It's just figuring out what are the costs per vehicle to the same level of detail. So for each option, how much is the cost for that model produced at that site? So just to walk you very quickly through one example here, the Fremont Model S, the reason this performance package cost is coming down is not because it's going to suddenly cost a lot less to do a performance package Model S. It's because fewer people are going to be buying it. So the revenue came down for this line item performance package. And that's why the cost, the average cost per Model S from Fremont sold is going to come down in sympathy with the revenue. That's what that's doing. So you get the idea on those. Let me skip down until something different happens. So let's look at Shanghai. We've got lower costs here than we had at Fremont. Well, I guess I didn't show you California's costs. So let me back up a little bit. Model 3 and Model Y, I had total cost of sales per delivery of like 39 grand for the Model 3, 40 grand for the Model Y. I don't think it costs them a lot more money to make a Model Y than a Model 3. They could be the same for all I know. Tesla doesn't release that information. This is my best guess. But if I scroll on down to where we were, Shanghai Model 3, I've got about a $27,000 cost for that vehicle. A little smaller, a $31,000 cost for the Model Y. And I've got the base cost rising a little in Q1. So maybe I've got a little room to play with that assumption. Uh, so that's the idea of what's happening with the cost of sales per vehicle. If I move on down to the Berlin Model Y, these costs are going to start high and then come down over time. You saw the same thing happening with the Model Y from Shanghai. This is just a factor of ramping up production. The more volume you do, the more economies of scale you realize, and the lower the cost per vehicle will go due to things like labor not costing as much per vehicle. When you're producing more vehicles per hour, you're paying for your labor by the hour, regardless how many vehicles are produced. So the more vehicles that get produced, the more ways those labor dollars get sliced. So it's a good thing to produce more and to sell more. That makes intuitive sense. You would figure that it's a good thing to make more, but it's virtuous. You're making more and at a better profit margin the more you make. Economies of scale and operating leverage are good things. Companies that have them grow their earnings by more than companies that don't. So we've got the Texas Model Y coming online very soon, and we've got those costs coming down. Those costs should be lower than Fremont's eventually. I mean, maybe it'll happen sooner than I'm forecasting it here. Again, there's a lot of wiggle room with this much detail by model to be right even accidentally if you've made offsetting assumptions, one high and one low. But by just the right amounts, they'll offset you to a correct answer. But the tricky thing is you never know exactly what you got right and what you got wrong because Tesla never reports in this level of detail. All right, so I've got Cybertruck here. I've got those costs coming down pretty quickly as that production ramps up. Semi, I've got just being a lot more expensive to produce for a long time than the profit Tesla will make because the volumes are so low, right? So semi is going to be a money losing venture for a while because they're just not going to be making very many semis for a while. That's my expectation that they're going to lose money making it, but not very much. I mean, look how small these dollar amounts are. That's $6 million. Not huge swings to the total P&L from inefficiencies at ramp up for these new sites. I see a lot of people worried about that on Twitter. Hey, they warned us on the conference call that there would be inefficiencies from the beginning of production from these new sites. Yeah, there will be. I don't think it's going to be devastating, right? It's not going to take a giant chunk out of the totals. And then we get to the total cost of sales dollars for leased vehicles versus cash sales, and then in total. That's what that page is giving you. So much information in this thread, 69 tweets worth of visual aids. All right, this one has the costs that go with the Tesla energy products and with services and other. So those get you to your total amounts, and then you've got total cost of sales here. So what you would like to see ideally is this cost of sales percentage coming down over time. And that's pretty much what I'm forecasting to see happen in the future. I mean, we have seen it drop, what, 8 points from the beginning of 2020 to the end of 2021. So is it possible we could see that drop another 7 points by the end of 2023? I mean, normally I would say no, that it seems too aggressive, except that Fremont will become an increasingly small percentage of the overall mix, and they're the costliest location to produce vehicles. So this gross margin is just one minus the cost of sales percentage. Hey, every time we produce one of these vehicles, how much money is left after paying for the cost of producing them? after paying for the costs of what the buyer gets, how much money is left before we pay for research and development, selling and general administrative, and taxes and everything. All right, so that starts us on the next section, which is the cost of sales percentages by site, by model, by revenue type, maybe by way of example. I'll just show you this performance package here. Hey, these percentages aren't crazy going forward, and I don't think the performance packages do have lots of very expensive equipment in them. So what you see is early in the Model X base, you would lose money on these at very low volumes like we saw in Q3, but that those would come down the more of them you sell and the more time goes by to allow you to gain efficiencies, get better localization of parts supply, et cetera, to drive down the costs per vehicle and per component. All right, so a lot of that is happening in this thread. Just calculating the cost of sales divided by the revenue gets you all these percentages. And those drive you to these costs by model. So here we're aggregating together the Model 3 and the Model Y, regardless of which site produces them. So you can see those cost of sales percentages here. And there's one here for Tesla Energy. So you can see the breakdown of none of these energy products being very profitable yet. And these are very small dollars on the other component. We'll see how this business does going forward. I'm not expecting them to make money in 2022 because they didn't make money in Q4 of 21, right? So it's more conservative for me to assume that that trend will carry forward for a while, at least until maybe the cell supply situation gets figured out and streamlined. All right, this takes us to the income statement. So here's the 58th tweet in the thread that I teased earlier. So I say I'm forecasting $17.75 in GAAP earnings per diluted share, or $16.40 excluding a one-time $1.6 billion tax favorability from prior year's losses in Q4. So let's look at this income statement. At the top here, we've got revenues. So we can see $17.7 billion worth of total revenue, most of it coming from automotive, with $1 billion from services and other. That's a good quarter for them. And about $500 million each coming from leasing and from energy. So here's what I'm forecasting those to do going forward. Most of the growth I expect is going to come from automotive, but they're all going to grow, right? Like energy, that's almost a double that I'm expecting by Q4 of next year. So year over year, this is going to grow by more than automotive. Should be a really good year as those solar production and energy storage devices recover from the supply chain and chip problems of 2021 and get more cell supply. Yeah, it's a lot of revenue growth here, but I think that's exactly what's going to happen. Tesla's going to sell a lot more vehicles this year than they did last year. So we've got the costs of sales below that. So the gross margin at the end of last year was 27.4%. You can see I'm not growing that much in the first half of the year, and I am growing it some in Q3 and Q4, with further growth expected the year after that. So gross margin percentages ought to be getting better. Prices are going up, costs are coming down. That's a good recipe. And hopefully you get more people buying that FSD package, the better it gets over time. Then we've got research and development here. Those costs I have at about what Q4 was going forward for next year, and then higher the year after that. Then we've got selling general administrative costs. What's this $1.5 billion hit about here? Well, there's a $340 million payroll tax expense hitting in here, as well as some CEO stock compensation expense hitting here. This is the GAAP profit that we're building up to here. So we include stock-based compensation in that expense. That expense is almost done. There's only 60 million of it left to pay in total. So that's why these costs are coming right back down again and not staying at 1.5. People are going to miss this when they do their forecast for Q1 earnings, but it's a real thing. So those are the operating expenses. Should be a lot lower in Q1 than they were in Q4, more like what we saw in Q3 actually, and in Q1 of 21. So those just give you the income or loss from operations. I'm expecting big and increasing numbers throughout 2022 on improving margins and better revenue, better cost containment. So you've got interest income going up a little. You've got interest expense coming down a little. Tesla is aggressively paying down their debt. So I don't know if it's going to get this low. I don't know if it's going to drop to zero faster than this. I've picked a middle path on what I believe will happen next year with smaller interest expense payments, the more debt Tesla continues to pay down. I think they have some debt that they can't pay down early without penalty, which they may just leave and pay off as it comes due. So that gets you to your GAAP net income that Tesla will report. So big numbers I'm expecting for earnings on these share count forecasts. So you've got basic and diluted, the difference being stock options that haven't vested through yet. So Elon has earned a bunch of stock options that he hasn't exercised yet. And then you've got GAAP earnings per share diluted here. So about $3-ish for Q1, about $4-ish for Q2. These are big numbers compared to what we have seen over recent years, and more than that in the second half, and high numbers thereafter. So that's my income statement. Let's move down to this next tweet and check out this visual. What do we see here? Well, we've still got the GAAP earnings per share diluted, the same number we were just looking at. I do show here the DTA, the deferred tax asset, flowing through the P&L. So if somebody wants to know quickly, hey, James, in Q4, you said you were predicting that Tesla's finally going to take that favorability from rollover losses in previous years. How much is that per share? It's $1.35 per share in Q4 plus 34 cents in Q1. So between the two of those, it's $1.70. I don't think they can take more than 80% in year one under the GAAP treatment. So if you want to back that out, then instead of 623 GAAP, it would be a little under $5 worth of adjusted GAAP EPS. What else do we have here? So I've got a Tesla stock price forecast here. If you just take 40x the next 12 months adjusted EBITDA, so you can see how this metric has been performing over the years. If you just take what adjusted EBITDA is going to happen over the next 12 months and just do 40 times that as the stock valuation multiple, you get these prices. I bet most of these quarters, the stock did trade at this price for at least one day during that quarter. Adjusted EBITDA is going to continue to grow over time. That's just a reflection of the company getting more profitable over time, becoming more of a cash generating machine. The better your company gets at doing that, the higher the price of the stock ought to go, because the people who own the company ought to believe that it's worth more and be less willing to sell at lower prices. So that's what this row says ought to happen. Then we've got a trailing 6-month average stock price here, which I needed to do some bonus calculations. A few of these lines are about that. So the $650 billion market cap level was the highest specified by Elon's 2018 CEO compensation plan. And that's why this row maxes out at 650 billion when Tesla held that valuation long enough to check the box on Elon's compensation plan that this was achieved in Q2 of 2021. Then the highest achieved adjusted EBITDA, you see this number rising over time. And then the row right below that shows you each of the milestones and which quarter they were achieved in. I think the $14 billion annualized milestone will get achieved in Q1 of 2022. And then you've got the other milestone goal metric from the compensation plan, which goes in different increments: 20 billion, 35 billion, 55 billion, 75 billion. And then it kind of doesn't matter after 75 billion what the rest of these do, because there were 16 possible milestones, but only 12 possible tranches. And this adjusted EBITDA is going to be achieved so quickly, you only would be able to use the first 4 goals, milestone goals for revenue. So yeah, that stock expense should be disappearing pretty soon. I've got the quarter ending dates here to do some calculations with. Here's some more CEO bonus information, how many milestones were achieved. You can see I've got 12 achieved by the end of 2022, which is also when the expense ought to be done. So here's the probable and unrecognized that gets reported every quarter. I forecast that as well. That's going to dwindle down to nothing by the end of the year. Then there's a breakdown down here of the stock-based compensation. So there's SG&A that's CEO stock comp, and there's other SG&A stock comp, and that gets you all of the oh, and then there's the third component of SG&A, which is everything else. If it isn't stock compensation, it's other. So that's how I forecast these as 3 separate things and then add them up to get my forecast for total SG&A expense. So I'm holding an assumption here that at the end of 2022, there will be another compensation plan for Elon, and I'm just placeholding $150 million per quarter as a seemingly reasonable-ish number based on history for what that compensation plan might do. So there is pay for Elon. I'm not stiffing Elon on his salary in my forecast for future years. I remembered. Then we've got stock compensation and cost of revenues. So this hits as cost of sales expense. Some hits within research and development, some hits within restructuring and other, not very often, but the line is there. I think in prior years, there was some as severance when layoffs happened and people were owed stock comp. So then there's other, these are always really small adjustments that you see. I don't forecast those to occur because most quarters it's 0. And how would I know what to forecast for that? Then we get to the non-GAAP earnings down here. So how are these different from GAAP earnings? They add back the stock compensation that's non-cash. It's not a real cash expense that the company had to pay. It's just the GAAP rules make you show the value of that compensation as though you had paid it in cash to your employees. All right, let's look at all the goodies available on Tweet 60. So this is the non-GAAP earnings line here. You can see what that is as a percentage of revenue, already up over 16% as of the Q4 2021 actuals. And you can see how that's grown from single digits in 2020, already up past 15% in both of the two most recent quarters. So I have that trend continuing into the future. With this 25% being a little deceptive, that's where the tax favorability is included, which I didn't mention on the previous page, but we've talked about it. So then we've got PEG metrics here. So you hear a lot of people talk about PE ratios, but PE ratios do not mean very much in isolation. Knowing the PE of a company is not enough information for you to decide whether it's a good stock to buy or not. The next important piece of information you need to get is how quickly are the earnings of this company growing? If the earnings are very stable and flat, a low PE probably makes sense. There's not a lot of earnings growth happening there. If the earnings rate is very high, then you're probably feeling pretty good about paying a pretty high relative PE to buy that stock. So that's what these rows are doing for you. So let's walk down the Q4 2021 row here. I'm forecasting $19 worth of non-GAAP EPS over the following 12 months. The E here is 1228 year over year non-GAAP EPS increase. So how much are the earnings growing year over year? This 19 minus this 678 is $12 worth of growth. This is tripling the Q4 2020 GAAP earnings or non-GAAP. So this 19 is adding up these numbers here, my 2022 earnings forecast, and this number are these EPS numbers that totaled 678 for the full year, just to let you see how that works. So the earnings are growing at 181%. That's awfully good, but that's been happening here for a while. It's been up over 150% every quarter for a long time. Those are going to start coming down because these dollar amounts are getting big. So when you've got really small dollar amounts, it's easier to grow them by large percentages. The larger those dollar amounts per share get, the harder it is to grow them by 200%, right? That's not going to keep up forever. So you've got PE ratios here. So I've got one here for the trailing 12-month non-GAAP earnings. So this is a backward-looking PE. This is what you're going to hear people quote. Oh, Tesla's at 150 PE. Next, I've got trailing 12-month GAAP earnings. So if you include the stock-based compensation expense, then that PE goes even higher because the earnings went lower when you change from non-GAAP to GAAP. Then you've got GAAP earnings over the next 12 months at a PE of 58. Well, that looks a lot better than 151, right? And it's currently trading as of, yesterday's close, well below 50 on the forward earnings that I'm forecasting. So those give you a PEG ratio that you can see. Peter Lynch said this number ought to be 1. So if you believe this number ought to be 1, then these are the Peter Lynch price targets for Tesla stock price. So just another way of looking at a stock price estimate. I threw Stevenson indicator on here as well. I touched on that in a previous video. So you can see this is just increasing by about $100 per quarter or $1.69 per trading day since Q1 of 2020. when it was down below $100 split adjusted. Hard for people these days to believe Tesla was trading below $100 that recently, but it's true. That was a bargain for those who bought. I did most of my buying 2014 through 2018, but it's been a pretty good run for anybody who's been in that long. All right, so we got add back interest expense. So we're doing the adjustment to get from GAAP net income to adjusted EBITDA here. Provision for income taxes, depreciation, amortization, and impairment. This is the gradual writing down over time of the value of the capital assets that a company possesses. So if you're a baker and you buy an oven that has a 40-year useful life, you wouldn't hit your income statement with the total cost of that oven in the same period that you bought the oven. You would capitalize that asset and then depreciate it over its useful life, taking only a small fraction of the cost of that item over each period until you had depreciated the value of that asset down to zero at the end of its useful life. That's what depreciation expense is. It's not a real cash expense, which is why it's one of these adjustments that gets you back to adjusted EBITDA non-GAAP, with stock compensation being another non-cash expense that explains the difference between GAAP net income and adjusted EBITDA. So we showed you the non-GAAP earnings percentages up here. There's the adjusted EBITDA margin percentages here. This is kind of a leading indicator of where the earnings are going to look at the adjusted EBITDA growth over time. So this should get a lot better as time goes on. We've also got an automotive gross margin here. We've got regulatory credits as a percent of revenue. So there was one quarter where regulatory credits were 6.7% of revenue, but that was only one quarter, and the 12 trailing months were never much higher than a nickel out of each average dollar of Tesla's automotive revenue. So that gives you the automotive gross margin excluding regulatory credits if you back those out. This is just that number minus this number, right? So you can see improvement. A lot of improvement has happened already in this number, up to 29%. And I've got that trend continuing forward. So here's a recap of production and deliveries. We saw this at the beginning. It's just down here for easy reference. There's also a breakdown here of revenue by type. So if you add up all the different revenues for each option type, those are here. We've got a cost of sales breakdown here to go along with the revenue breakdown. These are useful for making charts and stuff. Tweet 62 has cost of sales percentages by type. Also, we've got revenue per delivery, cost of sales per delivery, revenue per fully diluted share, 12 trailing month revenue per fully diluted share. So these are just showing you that, hey, even as more shares of stock are being added through stock compensation or years ago through equity raises, funding raises by issuing more stock, the revenue per diluted share is increasing and will continue to increase in the future. And these assume no share buybacks, because I don't believe share buybacks are the best use of corporate funds. That's going to happen after Tesla runs out of good ideas for really profitable products they can make and sell. It sounds like there's no shortage of those ideas currently for Tesla. So I've got the deliveries breakdown here. Again, that's repeated information from up top. So a couple of different ways of looking at that, either by site or all combined together for like the Model Y on one row, whichever way you'd like to see that. Here we've got revenue per delivery by model, by option type. FSD sales, net of deferred revenue per delivery, is a metric that I calculated. GAAP and non-GAAP earnings per delivery, and adjusted EBITDA and EBIT per delivery. So those are down here at the bottom. I used these to make some of the charts that I reviewed in previous videos. So these trends look pretty good for over the actuals time period and future years. Let's keep going. Tweet 65, we're getting close now. So here you see several trailing 12-month metrics, revenue and cost dollars needed to make those 100% stacked same size statement charts. I'm not sure if I called them that before, but all those bars that are all the same length and give you so many cents per dollar of revenue earned, or how Tesla spent each dollar of revenue. Those calculations are here. So you can see where I got to these pennies that land on those charts. That's slide 65. Slide 66 is more of the same. I had to calculate it by quarter first and then do the 12 trailing month averages. This section shows estimated total cost of sales percentages by product and site in the case of most vehicles. So what do we think the cost of sales percentages are on these models over time? This looks pretty wacky, but the sales were very low on Fremont Model X's in Q3 of 2021. And we do expect those to come down below 100%. So stop losing money on Model X as the volumes go back to normal again. But you can see those don't have a very big impact at the bottom line, where things are continuing to improve in total. Yeah, looks good. Until you get to the non-automotive section, and the Tesla energy percentages are here again. Well, this I have high hopes for this business in the long term. In the short term, I expect to get more of what we've been getting lately for those, and then services and other ought to get better over time. All right, slide 68, gross margin percentage by product and site in the same format as cost of sales above. So this is just 1 minus those cost of sales percentages. If you'd like to view these as gross margin percent instead of as cost of sales percent. So these negative numbers here for semi shouldn't be concerning you too much. Yes, we're going to lose money on that product for a while, but at very low volume. Yep, and then we're going to lose some money in the Tesla energy business for a little while before that flips to positive. That's my expectation. That's what's in my forecast. And the last tweet in the thread is about the CEO Performance Award. There isn't a lot of mystery left for this, as there once was. I needed to build this board so that I would get a reasonable forecast in for compensation expense over time. So you can see big amounts were getting expensed here until recently, and they're going to be less than 20 million per quarter probably in the forecast. That's what I'm thinking will happen. So I would talk to you about how this works, but you're probably ready for me to just come back to full frame again and say thank you for sticking with me through this Tesla forecast review in detail. If you liked this video, click like. If you'd like to see more videos like this as I release them and you haven't subscribed yet, you can subscribe to my channel, and I will see you next time.